Okay. Assalamualaikum warahmatullahi taala wabarakatuh.
Waalaikumsalam, sir.
How are you? Everybody fine?
Alhamdulillah. Thank you, sir.
Good.
Okay. Okay. So as I have promised you, inshallah today, I will basically discuss a discussion on MFRS 15 on revenue recognition from contract with customers. Actually, I'm not feeling well in the morning, but I think now I'm a bit better. So inshallah, I will try to discuss the first part of the accounting standard. I will basically looking into the main criteria which have been explained by the standard in recognizing revenue from a contract with customers. Okay, so I have been uploading in your Google Classroom slide on interim reporting, but that one I will basically leave it to you to go through the slide on interim reporting. I have also uploaded the slide for revenue recognition. Okay, both slides are basically from the textbooks. Okay, then I have also uploaded few more documents in order to illustrate about revenue recognition. Okay, one more document is more on trying to illustrate further on revenue recognition. The other one is I just actually scan through some of the examples from the textbooks. I hope you also have your textbook with you in order to facilitate the discussion on revenue recognition. Okay, so inshallah we will go straight on the discussion from the standard based on what has been explained from the textbook on the issue of revenue recognition. So I will just following the slide. Okay, let me just put through the slide. Okay. Okay. So as I have said to you, this is a new standard. Okay, as a new standard on revenue recognition, where basically it has highlighted a bit more detail on how a company should recognize a revenue from a contract with the customer regarding their business activities. Okay, so they are detailing out some of the main criteria which companies should look into in order to recognize revenue from the contract with their customers. Okay, so I just skip the earlier slide. Okay, like the cover slide and so on. I just go straight to the main issue. Okay, so in order to help a company with the revenue recognition, okay, with recognizing a revenue, there are few main steps which company need to look into. Okay, first, of course, company must identify existence of a contract with their customers. Okay, of course, there are certain exceptions. Okay, of course, there are certain exceptions to the application of this standard MFRS 15. Okay, because not all kind of a contract is basically applied under this MFRS 15. For example, when you look into leasing, okay, lease transaction, when you want to recognize revenue from a lease, you need to follow MFRS 16. Okay, so that is the exception. Although theoretically, I have some concern. Okay, because when you look into lease, lease is also a contract with a customer. But of course, I think from the conventional perspective, they are looking toward leasing a bit different from a normal contract from a customer in the business activities. Okay, So there might be some slight differences from a normal contract with customer for business dealing or business transaction compared to leasing. Although leasing is also a contract, but there is an exception, okay, from using this standard for a leasing transaction, because leasing you must follow MFRS 16. Okay, of course, other kind of business dealing with your customer, you need to identify a clear contract between an entity and the customer. That is basically the first step in recognizing a revenue from a business transaction or business dealing based on this MFRS 15. Okay, first, an entity must identify contract with customer. This basically highlight the importance of having a clear contract between an entity and the customer for any business transaction. Second, of course, we will basically discuss in a more detail, but we just look into the whole scenario. The second step is for a business entity, whenever they have a contract with their customer, they must also identify what is their obligation. Okay, what is basically their obligation. Okay, either in providing a good or providing services to the customer. From the contracts, an entity must be able to identify what is the term which they use in MFRS 15 is performance obligation. What is the obligation on the part of the company which they need to perform to their customer? Because only after they have performed such an obligation, then only the company can recognize the revenue from the contract. So recognition of a revenue will only happen. That is the last step actually. Okay, recognition of the revenue will only happen when the entity satisfy their obligation which they need to perform to their customer. Okay, so in the contracts and also in identifying the performance obligation, the next step is to basically identify what would be the price of the transaction. Yeah, what would be the price of the transaction? And of course, there are certain formula which has been suggested. Okay, by the standard in determining the price. Okay, of course, the price is not only the stand-alone price of the transaction. Okay, there are some other component which should also be included in determining the price. For example, if you are basically uh, supporting your business transaction through loans, for example, and therefore you need to incur interest, that should also be included in the determination of the price. Okay, so I'm just talking purely from the conventional MFRS 15, where, for example, interest is basically also a component in determining the transaction price. Of course, if you try to basically discuss from perspective of Sharia and some other perspective, um, uh, of course, maybe we can basically replace this with other component, might not be an interest, but might be the profit margin or whatsoever, which is more Sharia compliant. Okay, but that is the other component which could also be included in determining the price. So the price is not only the stand-alone price of, for example, an asset which you need to basically deliver to your customer, but it can also include some other component. We will look into that, how to basically calculate the transaction price, and if the performance obligation involve, okay, more than a single performance obligation. Therefore, of course, you need to basically allocate the transaction price into the respective performance obligation. Okay, into the respective performance obligation. Is the contract have identified more than once? Okay, performance obligation. Later, I think, inshallah, I will also illustrate this. Therefore, you need to basically allocate the transaction price of the contract, okay, of the contract into the respective performance obligation which the company need to performs. Okay, which the company need to perform. So this is 5 main criteria before you come to the last step or the last criteria where you basically recognize a revenue when an entity have satisfied its performance obligation. So let's look into a bit more detail into each of the step. Okay. So first is identifying contract with the customer. How do you identify the contract with your customer? Okay. So there are 5 main elements in the first step. Okay. So of course there must be approval because in the contract there would at least be uh, two contracting person. Okay, two parties in a contract, and both party must agree. Okay, must approve. Okay, must approve. So the two party in the contract must agree with the term and the condition, and this can basically happen in terms of the writing, in terms of yeah. Can you hear me? Do you have any? I heard a voice. Any problems?
Yes, sir. Can hear you. No.
You cannot hear me?
Can hear.
Can hear.
Can, sir.
Oh, can hear? Okay.
Yes, yes.
Okay. So I thought there is a problem. So I just continue. Okay. So of course the parties in the contract must agree. Okay, and of course the best is basically if the contract is basically written. Okay, is basically written because there will be a clear evidence clear evidence in terms of the agreement between the parties to the contract. But of course, in today's business environment, okay, you have further development in terms of technology and so on. Of course, sometimes it might not be written, so oral agreement is also might be accepted. For example, if you look into your textbook, example 7.2, okay, 7.2, that is just try to highlight that even an agreement in oral, okay, in oral communication is nowadays being accepted. So it might not be just in a written agreement, but oral or some other form which is agreeable between the two parties. They can basically be considered as a contracts. Okay, as a contracts. So of course that is the first one, and the contract will basically identify what are each party's rights. Okay, what are the right of each parties, and how the payment will be. The payment will also be identified, and of course the contract must have a commercial substance. Okay, the substance of the contract must be of uh, those who have an economic substance, and of course first of course the term of the payment should be identified. Okay, how much is the price, how the payment should be made, whether the payment should be made by an installment. Okay, so that is the earlier one. The third criteria, the terms of the payment should be able to be identified, and the last one related also to the payment consideration. The payment of the consideration must be highly probable. Okay, so you should have an assessment or evaluation that the customer will be able to pay you. Okay, to pay you, then only you will be able to recognize that as a revenue from the contracts. Okay, so if you look into your textbooks, example 7.1, 7.2 is just illustrate uh, about identification of the contract. Example 7.1 just try to highlight about this issue of probability of the payment by the customer. Okay, so it must be the probability must be high that the customer are able. You need to have an evaluation that the customer have ability to basically pay you once you have performed the obligation, and then only you can basically recognize a revenue. 7.2 is basically just highlighting about oral agreement. I think in today's environment, for example, communication might be just done over the internet. For example, this is become an acceptable business practices. Okay, So you just not need to meet face to face, okay, do a written agreement, something like this just through an internet communication might be something which already been acceptable in terms of having a contracts. Okay, so that is basically the 5 element or criteria in identifying a contract with your customers. Uh, then if you look into your textbook, there is quite a brief explanation about issues of a combination of a contract. This issue will only arise if you have few contract with a same customer, okay, a same person. You have few contract which has been done with a same person, okay, and the timing of the contract is almost at the same point of a time. So these few contract which you have with the same customer, can you just combine it into a single contract? So in of course this would be able to facilitate the recognition of revenue rather than you are recording um, more and more contracts. So if there are certain contracts which you can combine, specifically in this provision is where the contract is with the same customer. So whether you can combine, okay, there are certain criteria. For example, if your contract arises from a negotiation, okay, a negotiation. That means although you have few contracts, but you negotiated it as one, okay, where you might have delivery of at different stages, for example, then that one can be actually be combined into just a single contract in order to facilitate the recognition of the revenue, or for example certain term in one contract is dependent upon the term of another contracts. That could also be a justification to combine the contract into one. Okay, so this is just a very short explanation. I try to find a further illustrative example, and I think is most of the accounting companies or audit firm or accounting firms, they have not explained further. I think this is just a provision which would be able to be applied in order to facilitate further. Whenever you have a contract with the same customer, there is a possibility to just combine few contract with the same customer into one contract in order to make it more easier for the recognition of a revenue. But the next issue is quite an important issue. Okay, the next issue is quite an important issue. Okay, for examples, if you have modification, okay, to the contract which you have already written with your customer, when you look into the discussion by the standard, modification can happen or arise from two perspectives. One is what they call changes in the scope or modification in the scope. Second is what have they call changes or modification in price. Okay, if I want to give some example, okay, for example, a modification in the scope, that might be changes in, for example, let's say it is a computer set. Okay, you are basically selling a computer. Of course, computer will come with um, certain criteria or certain, for example, like what is their processor, their screen, okay, something like that. For example, whether you use Celeron, whether you use IP5, okay. So in terms of the processor, what is their capacity with regard to RAM? So you need to basically you need, whenever you want to buy a computer set, of course you need to agree specification. Of course, the word just come to my mind. Specification of that computer sets. Okay, so let's say suddenly you might find out that not all specification you can meet. Okay, in order to supply that computer set to your customer, you might need to change slightly on the modification. This might be an example of changes in the scope. Okay, so you change the modification because might be unavailability of those specification, okay, to what you have. Okay, so this is what you can basically given as an example of changes in the scope, or sometimes might be the price itself change due to might be due to some condition, okay, some something happened in the environment suddenly, suddenly the cost might have increased, and because of that the price might have changed. So when you have these changes in the scope or price, the issue is whether you should just do the amendment and still continue with the original contracts, okay, or whether you should all those modification will be accounted as a totally new separate contracts, okay. So whether the modification will render to just an adjustment to the original contracts, or whether the modification will render toward creation of a new separate contracts with your customer. Yeah, of course, I think logically you might already have some understanding. If the modification is just small, yeah, or just little, then that should not render toward writing of a new contract. But if the changes or modification is significant and suddenly it changed, okay, whenever you change the, for example, specification of the computer, it have changed significantly, this new specification with the old specification, then might be you need to write a totally different kind of a contracts, okay, and the old contract might either be terminated and you just write a new contracts. So that is what have been written on your slide. You need to account a separate contract if the changes in the scope or price is basically distinct, okay, and the change in the contract reflect a stand-alone selling price. So of course, when the changes is significant, the price will also have changed significantly, okay. However, if the other treatment is it should not lead toward a separate contract, but it can just either be accounted as you replace the original contracts, okay, replace the original contracts. The first one is actually the original contract is there, okay, but you write a new contract because of the modification. I will basically give you some illustrative example. The second one is you either, for example, terminate, okay, replace. That's mean the original contract is terminated, okay, and then you just write a new contract to replace the original contracts, okay, to replace the original contract, or you don't need to do a replacement, but you just modify the term and then continue with the original contracts. So in order to illustrate this, okay, I just have also uploaded, okay, okay, can you see this? Can you see my document?
Yes.
Yes,
Okay,
sir.
Yes.
okay. Okay, so this is my illustration about contract modification. Okay, contract modification. Okay, for example, if you look into my initial contracts, yeah, my initial contracts, company A first enter into a contract with a customer to provide 20 set of computer with a processor of Intel Celeron. Okay, 1,500 on 1st of January. Okay, then you can continue with regard to the payment of deposit and so on. Then the first illustration, suddenly on 15th of January, the customer, okay, your customer require an additional set of computer, but with a different specification. Okay, so that's mean the initial contract fine is still there. Yeah, it's still there. The same customer come to you, suddenly says that I want an additional set of computer, but a different specification. For example, Intel Core i5, and the price is 3,000 per set. This is a totally distinct good compared to the first contracts. Okay, So this is totally a distinct good from the initial contracts. So when you have this, you cannot combine this new additional requirement of the customer to the original contracts. Cannot, because the scope of this new additional good which is required by your customer is totally, I can say, is totally or significantly different from the original contract. So you cannot just put this additional requirement into the original contract. What you need to do is, for this additional five more set of computer with a different specification, you need to write a separate contract. So the original contract is still there. Okay, original contract is still there, but for the second request or requirement, you write a different contract. That means now you have two different contracts with the same customer with a different set of specification, and that is the first explanation, where you need to write a separate contract because the new change requirement by the customer is totally a distinct product from the original contracts. Okay, so that is the first explanation. Okay, then the following explanation is about you don't need to write a separate contract. The issue of don't need to write a separate contract can be explained from 2 points. One is you change the original contract with a new contract. That means terminate the old and then create a new one to replace the old. That is the difference between the requirement of writing the new separate contract, because the first one, the original is still there, and then you have an additional new contract. But when it says does not require a separate, that could be understood as replacing the original contract with a new one, or does not need to change. The second approach is just modify the term and then just continue with the original contracts. Okay, just continue with the original contracts. So the second illustration is basically explain that. Okay, same information, okay, as the original or initial contract, where you have a contract with the customer to deliver 20 set of Intel Celeron computer. So on 31st January, you already delivered 10 units, okay, 10 units. However, for the remaining 10 unit, you cannot provide at the price which you have agreed earlier, which is 1,500. Maybe you can just deliver at the price of 1,500 based on the old stock, but the new stock suddenly slight increase in the price. So for the remaining 10 more units, the price has increased slightly to 1,600. Okay, 1,600. This is an example where you just continue with the original contract, but you just change the terms slightly due to the increase of the price. If you look, the third entry is basically your adjustment because of the increase of 100. Then you recognize increase of receivable of 10,000 because the remaining unit to be delivered is 10 units or 10 set, and then you credit your contract liability by the same amount. This is just a continuation. Okay, you just continue because the changes is just slightly by 100. So you just not need to terminate the original contract, but you just need to have an agreement with your customer where there is due to certain situation, the price have been agreed to, the price have increased by 100. So of course, if the customer agree, then you need to just provide a necessary adjustment without having to terminate or write a new contract. Just do an adjustment. Okay, so that is the second illustration. Okay, the third illustration. Okay, the third illustration is like the second one. Okay, so you have delivered 10 units, but for the remaining 10 unit, okay, for the remaining 10 units, for certain reason, you can only, the price with this for this set has suddenly increased For example, almost double. Okay, so you have sent 10. You need to send another 10, but you cannot get at the price you should have agreed, and the price have increased significantly. Okay, in this case, terminate the old contract and write a new contract to replace the old contract if it is agreed again lah. If it is agreed again between the entity and the customer, because the increase in the price is very significant compared to the original price. So you have sent 10, that's one complete. Okay, the remaining 10, terminate that contract because you cannot deliver at the price of 1,500 anymore. It's increased significantly to 2,800. I just put okay, to just show a significant increase. Okay, so just terminate the old contract and write a new one to replace the old. Again, of course, agreement must have been reached between an entity and the customer. Okay, and here, okay, here I think if you look into your book, is a condition where there is yes and no. Okay, that's mean from the remaining 10 units, you can deliver another 5 more units. Okay, at a slightly increased price. But for the remaining 5 more unit, it need to be replaced with a newer model at higher price. Okay. Since there is yes or no, then you just need to do a modification. Okay. A modification to the original contracts. Okay. So you cannot terminate totally because illustration 3 is totally different because all the remaining unit you need to send at a significant increase of price. But number 4, some you can still deliver it at almost the same price, but only certain unit you need to basically change it with a new model at higher price. So in this case, you need to follow like illustration number number 2. This is just my illustration with regard to modification in the contracts. Okay, modification in the contracts. So generally, what can I conclude? You have two possible treatments. Yeah, one is whether you need to really like and really write a new separate contracts. Yeah, or you don't need to write a totally new separate contracts. Yeah, but you just need to modification or adjustment can be done by terminating the old contract and write a new contract, or just do a necessary adjustment to the original contract and continue with the original contracts. I stop here for a while if you have questions. Do you have any questions?
Sir,
Okay.
so to know whether it's a new contract or not, it is distinguished by stating the date, right?
Distinguished by?
Stating the date.
Stating the date?
Yeah.
But sorry. What you mean by stating the date?
Like, okay, the first illustration, right? The first one is on 1st January, and then after the change of the contract, a new contract is initiated on 15 January.
Okay. Yeah, then?
But for illustration 2, I mean 3, it happened on the same date, or
okay, let me just illustrate.
how do we know if it's a new contract?
Okay, as I said, as I have started the discussion, okay, the issue is change in scope or price, which is distinct or not. Okay, change in the scope or price, which is distinct or not. Okay, for example, like change in the scope which is distinct, for example, might be they want an additional set which is of totally separate specification. Okay, totally a separate specification, or for example, there is a significant increase in the price. Okay, there is a significant increase in the price. So you need to write a totally new contracts. Okay, a totally new contracts. If, for example, if you have not delivered it yet, then you need to write a totally new contract because the changes is basically significant. If the changes is not significant, then you can continue with the original contract. That is basically the idea. Is that could be understood? Nothing have to do with the date. Is that okay?
Okay, sir. Okay.
You need to look into whether the changes is significant or not. Usually, if the changes is just slightly, of course, this will depend on company interpretation lah. Okay, what do you mean by distinct? Yeah, what do you mean by significant? Okay, this would depend on the company interpretation. Whether increase by 50 or 100 is something which is not significant, then you can just continue with the original contract with modification of the price. But whether increase the price by 1,000 is something which is significant, which might lead you toward writing a new contract. That is basically the issue. But the date to me is not, it will not be determining whether you write a new contract or not. Okay? Sister, I think that is my explanation at the moment. Hope you can understand.
Okay, sir. Thank you.
Okay? Okay. So that is of course one of the issue. Okay, how would you how would you how would you record? Okay, how would you treat if there are changes in the contracts? Okay, is there is changes in the terms of the contracts? Okay, so two possible treatment: account as a separate contract, or just modify, just treat the modification as an adjustment to the original contracts. Okay, then step number two. Okay, step number two is to identify what would be the obligation, of the company, okay, to their customer. I think I would like to highlight that, okay, of course, the obligation of the company or the entity might be in terms of delivering the good or providing the services. But I think if you look into the bracket there, the good and services must be a distinct good or services. That means you can identify the good to be separate from the other good in the contracts. Okay, that means you can identify. Okay, you can identify distinctively. Okay, the goods from the other goods which you have agreed in the contract, because this is very important. Okay, because if you are not able, okay, if you are not able to, for example, differentiate, okay, between the goods, okay, which is agreed to be sent to the customer. For example, you might be sending it by batches. So of course you need to be able to identify what are the batches of the good which you have sent with the batches of the good which you have not sent. Okay, because once you deliver the first batch, for example, then of course you actually can recognize part of the revenue from the contract with your customer. But of course, the requirement is ability to differentiate, okay, between the goods, okay, from one to another. Because you are not able to basically identify, then there might be slight problem. How would you recognize a revenue? Okay, how would you recognize a revenue? Because the condition is, as you have performed your obligation to your customer, then of course you can recognize revenue, but in related to the good which you have delivered to your customer. Therefore, company must have an ability to differentiate or identify distinctively between the goods, okay, between the goods which they have agreed to be sent to the customer. Okay. Of course, this is just a criteria how you identify distinctively from the other good, which means the good which you have sent, it can be operate without waiting for the other batches of the good to be sent. Okay. So that is a criteria of a different or distinctive. Okay. That means whatever you have sent, your customer can basically utilize the benefit already from the first batch of the good which you have sent without having to wait for the second batches of the good to be sent. Or you can identify separately identifying, for example, like certain goods you might have a serial number, so you are able to basically distinctively identify the goods, okay, which you need to deliver to your customer, okay, either the good or services. So that is one important criteria. The good which you have transferred, okay, to be transferred or have transferred to your customer must be a distinctive good or services, because this will be a criteria for you to start recognizing the revenue from your contract with your customer. Then the next issue is basically determine the transaction price. If you look into your textbooks, it's basically on page 177. Yeah, 177. And of course, transaction price, the main component, of course, the selling price of the goods or services, plus some other aspect. This is the other four aspects, like variable consideration. I will just take one example from variable consideration here is like discount. Okay, this is variable consideration, because might be with certain customer, they don't get the discount. You might have a criteria. For example, might be a simple criteria is if you pay within 15 days, for example, and then you will get a discount of 10%, for example. So if you pay within certain period of time, then you get certain other discount. This is a variable condition, and what will be your expectation with your customer? Okay, so if you are expecting your customer will basically able to get a discount, then this discount will basically adjust the value of the transaction price. Okay. Second is financing component. This is what I have said earlier. The interest can be considered as part of the price of the transaction. And if you want to look further with regard to illustration of interest, you can refer to illustration 7.7 from your textbook. That is where they illustrate, okay, where interest can be a component of transaction price. Sometimes your transaction price include non-cash consideration. For example, your customer, when they pay, they will also part of their payment come in the form of non-cash transaction. For example, they give you certain non-cash assets, so you need to value this non-cash consideration at the fair value to estimate the price. Okay, sometimes in order to have business dealing or transaction with the customer, sometimes you also have certain consideration payable to the customer. For example, you offer your customer vouchers, for example, or some cash, some vouchers or coupons. Okay, so this is consideration which you need to pay to your customer. Okay, which you need to pay to your customer. That could also be included in the calculation of the transaction price. Okay. So of course, consideration payable to customer, that will basically reduce the value of the transaction price. Okay, transaction price, selling price, then variable consideration, financing component, and non-cash. Okay, non-cash consideration. All this will basically increase the value of the transaction, price. Okay. So that is theoretically, inshallah, I will basically, you can look into example 7.4 with regard to the transaction, okay, with regard to the transaction price. So if you have, I'm sorry, I have not been able to scan this. I'm scanned from example 7.5. If you have a book with you, you can refer to page 178. But for those who might not have the book available with you at the moment, I will just read this example 7.4. Okay. In this 7.4 is about transaction price. Kimchi Berhad entered into a contract with a customer on 1st of January 2018 to sell product A at 100 per unit. That is what they have agreed. Okay, that is what they have agreed on 1st of January 2018. Is customer purchase more than 1,000 unit of product A in a year, in a calendar year, the contract specifies that the price per unit is retrospectively reduced. Okay, retrospectively reduced to 90 ringgit per unit. Okay, 90 ringgit per unit. That means originally when they have an agreement or contract with the customer, the price is 100 ringgit per unit. But if the customer is purchasing more than 1,000 unit in 12 months, okay, in 12 months, that's mean from 1st January until 31st of December 2018, if the customer purchase more than 1,000 unit, the entity or the company will reduce the price from 100 ringgit to 90 ringgit per unit. Okay, so consequently, the consideration of the contract is basically variable. Okay, so if the customer purchase less than 1,000 unit in a calendar year, in 12 months, the price is 100 units per. Okay, 100 unit. 100 ringgit per unit. If the customer purchase more than 1,000 unit in 12 months, the price per unit will be 90 ringgit. Okay, will be 90 ringgit. So this customer for the first quarter ended 31st of March 2018. Okay, the customer in the first quarter, the first 3 months ended 31st March 2018. Okay, have buy 75 units of product A. That means kimchi sells 75 unit in the first quarter to the customer of product A. That means the first quarter is sold 75 unit. So at the end of the first quarter, at what price kimchi will record? Okay, at what price kimchi will record? At what price kimchi will record the revenue? So if in the first quarter it sells 75 unit, what will be your estimate with regard to the sale to this customer in 12 months? In 3 months, kimchi sells 75. So in 12 months, what will be your estimate of the number of units sold to the customer? So 3 months, 75 unit. That means if the patent stay, if the patent stay in 12 months, kimchi will only be able to sell to the customer 300 units. 300 units. So the expectation by kimchi is the customer will only buy less than 1,000. So that's why at the end of the first quarter, okay, at the end of the first quarter, kimchi will record the sale at 100 ringgit. Okay, at 100 ringgit. That means 75 unit multiplied by 100 ringgit. So it will recognize a revenue of 7,500. Okay, so now on then the information continue. In May 2018, kimchi sell another 500 unit of product A to customer. Okay, so first quarter sell 75 unit. In May 2018, kimchi sold another 500 units. So for the first 6 months, kimchi have sold 500 plus 75, that means Kimchi have sold 575 unit of product A to the customer. So now your estimate change. Since you have sold to the customer 575 in the first 6 months, your expectation is if this trend continue for the remaining 6 months, okay, remaining 6 months, then the customer will buy more than 1,000 units. Okay, because 575 in the first 6 months, if you have 575 for another 6 months, that will be equivalent to 1,150. That is more than 1,000 units sold to the customer. So because of the transaction in May, then Kimchi Berhad revised, okay, the price from 100 ringgit per unit to 90 ringgit per unit. So that's why when you look into the calculation, okay, the calculation for the second sale to the customer, you sell 500, okay, 500 units, okay. If you look into the books, 500 units multiplied not by 100, because now you're expecting customer to buy more than 1,000 unit, so you multiply by 90 ringgits, okay. 500 multiplied by 90 ringgits, okay, multiplied by 90 ringgits, then you minus the adjustment of the previous first transaction of sale of 75 unit. So the difference is now you need to adjust the price. Previously you recognize at 100 ringgit. Okay, now you basically need to recognize the revenue at only 90 ringgit. So the difference is basically 10 ringgit. That will be the adjustment with regard to the revenue recognized. Okay. So I think the important word when you look into the question is, okay, whenever the price, okay, so if the customer purchase more than 1,000 unit of product A in the calendar year, the contract specified that the price per unit is retrospectively reduced to 90 ringgit per unit. That means even for the earlier sale transaction with your customer, you need to do the adjustment. Okay, so that's why you need to adjust the difference of 10 ringgit, because previously in the first sale transaction with the customer, you record the revenue at 100 ringgit. Now you need to adjust the price retrospectively just to 90 ringgit, because your expectation now your customer will buy more than 1,000 units. So based on that calculation, the revenue which you should recognize on in May 2018 is 44,250. So that is the adjustment which you need to make because of the variable conditions. Okay. So any question with example 7.4? Can you understand example 7.4? I stop for a
Sir,
while here. Any
yes, sir.
yeah, any question you want to ask about 7.4? Any question?
Sir,
Yes, sister.
I actually don't understand. He stated
Yes.
that if the customer purchase more than 1,000, then only the
Okay.
price will decrease to 90 ringgit, right? But
Yeah.
now he only purchased 500 ringgit. So why the price is decreased to 90?
500 ringgit.
Sorry, 500
Okay.
units.
Units. Okay. Because the purchase of 1,000 unit is calculated based on the calendar year, 12 month. Okay. Okay. That is a purchase in 12 month. Just by May 2018, the customer have already purchased 575 units. Do you follow me? Just in the first 5 months.
Okay.
That means the customer still have, I say lah, that is half year. Then the customer have another 6 months to do the purchase. Okay, to do the purchase, because 1,000 unit is calculated based on the calendar year, which means 12 months. So if in the first 6 months the customer have already purchased 575, and if the estimate is maintained like that, that's mean for another 6 months, the customer will probably purchase another 575. The customer will probably purchase another 575 in the remaining 6 more months. That will be 575 in the first 6 months, 575 in the second 6 months. That will be that will be in total equivalent to 1150. That is where your estimate is basically go beyond 1,000 unit. Can you understand, sisters?
Yes, sir. Thank
So,
you.
Okay. Yeah.
sir,
Any other question? Yep.
what if the estimation is wrong?
What is the estimation is wrong? Then you need to adjust again. Then you need to basically adjust again. Tapi tidak. Wait. Uh, wait. Because now for okay, I think it is retrospectively changed. Okay, good question. Let me. I just need to think. Um, because what you are basically saying that maybe for the remaining 6 months, the customer
Yeah, you wouldn't reach
only
to
purchase
1,000.
just another 200. That does not reach to 1,000.
Mm, mm,
Mm, yes, mean the price should be then the price should be at 100 for the good question. I need to think. Okay, I need to think. Can I, because if for the current transaction is fine, but what will be for the retrospective adjustment? Okay, what will happen for the retrospective adjustment? Do you increase back? Cannot increase back to 100 to 100. Good question, sisters. Can we just take this for my homework and address back to you in our next class on Wednesday?
can, sir. Sure.
Okay. Good
Yeah.
question. I need to think a bit more what would happen. Okay, because all this is basically based on estimate. Okay, let me do some homework and come back to you on Wednesday. Okay, sister, thank you very much. Any other
Okay.
question?
Yes, sir.
Any other question?
Sir, I want to ask,
Yep. Yep.
um,
Yes, sister.
for the journal entry,
Yep.
so for May, you record at the 90 ringgit price first, or this adjustment like after year end? The time frame.
Yeah. Okay. Because the illustration is just about the price. Okay. So for the first quarter, it will recognize a revenue. Okay. Contract liability. Oh, this is where, because I think what you are trying to ask is, because usually what would be the recording is, okay, you need to recognize a contract liability. Okay, you need to recognize a contract liability.
Sir, you're muted. Sir,
Okay.
hello.
Okay, now you can hear me. uh,
Yes, can.
uh, okay, so of course, you might also be correct because usually here is just try to illustrate about changes in the transaction price. Okay. I think if you want to understand the whole scenario, is of course it will start with a recognition of the contract liability, which is the company's performance obligation. Okay, the company's performance obligation. So if you look into my illustration, it will start with when you debit receivables, where you expect the right of the right of the purchaser, to basically pay you, and then you need to recognize your performance obligation to your customer, where you basically will credit contract liability. That is that is the whole scenario. That is the whole scenario. But of course, that one is not clearly illustrated here. It's not clearly illustrated here because it only says Kimchi enter into a contract with a customer on 1st of January to sell product at 100 ringgit per unit. So we understand that on 1st of January 2018, the transaction price determined is basically 100 ringgit per unit. However, of course, in the contract itself, because that is the variable component, when you have, if you purchase more than 1,000, then you need to recognize at 90 ringgit per unit. I might need to because on the initial contract, on the initial contract, there is no clear identification of the numbers of the unit of the good to be sold to the customer. It's only say that if it is purchased 1,000 unit in a calendar year, then the price would be 90. Can I ask for because I really need to look back into this example, because the illustration here is just to show the changes in the price from 100 ringgit to 90 ringgit. Maybe I need to try to provide you with a journal entry from the initial contracts, from the initial contracts until 31st of May. But another question by a sisters, what happened if, what happened if the estimation of selling more than 1,000 unit have not been met? That require that might require a bit more of a thinking, because what I just thought, I just would like to illustrate here according to the example on the changes in the transaction price. So I would ask for some further deliberation. So inshallah, I will try to provide you with a more complete scenario lah, from the initial date of the contract, hopefully until May 2018, together with what would happen if your estimate have not been met, where the customer finally have not been able to purchase 1,000 unit of the product. Can I defer this discussion on example 7.4, because I need I think I need to think further, because this one have not illustrate all the issue which you have just raised just now. Is it okay, sisters?
Can.
But don't just leave it to me. I think you should also start thinking. Start thinking on this. What would happen? What would happen if all that scenario basically happening in this kind of a contracts? So I hope I will be able to come with a much more comprehensive illustration on this scenario. Sorry, sisters, I will come back to you on Wednesday. Is that okay?
Okay.
But inshallah on Wednesday I will try to provide further illustration. You have put me a very good question. So of course, sometimes sometimes example just try to focus on certain aspect, does not look from the whole scenario of the initial recording until until the completion of the performance obligation. And here it also involve certain kind of estimate on the variable consideration. Okay, so might be for today I will stop here on transaction price, but before I stop I will just try to share you another examples, okay, from 7.5. This is where you have one or more of performance obligation. Again, I'm not sure. I think you come with a very good question today. Okay, with a very good question today. I need to think more. Okay, in order to come with a more comprehensive illustration rather than what have been provided in the textbooks. Example 7.5 is basically try to illustrate to you. Now this is on page 180. Okay, how do you allocate a discount to one or more performance obligation? Okay, so this is trying to illustrate again allocating a discount to one or more performance obligation. This is also related to determining the price. Okay. So if you look into the question, kimchi sell product A, B, C. So if you look into the standalone price of product A, B, and C is 40 ringgit, 55 ringgit, and also 45 ringgit. That is the standalone price. Is the customer purchase individually A, B, or C? But the company also offer the customer, if customer buy product B and product C together, it will just sell it at 60 ringgit. So if you look into product B and C, if the customer buy individually, the price will be 55 ringgit and 45 ringgit respectively. So if you combine the standalone price of B and C, that will be 100. But if the customer buy B and C together, okay, buy B and C together, it will get a discount of 40 ringgit, where the price will only be 60 ringgit. Okay, 60 ringgit. So the first issue is, okay, the first issue is company is basically selling A, B, and C. Okay, would the discount given by the company be allocated to all the product A, B, and C, or would it only be allocated to B and C? Okay, to B and C. Since the discount is only been given to purchasing product B and C together, therefore the discount of 40 ringgit should just be allocated to B and C only, should not be allocated to A. Okay, to A, because this discount is only applicable when the customer purchase product B and product C together. Okay, so that is one issue. Okay, so that will be one issue which has been explained in the example 7.5. Okay, so the allocation of discount should only be allocated to product B and C. Then in the requirement you will see that if the if the entity transfer control and of product B and C at the same point of time, okay, do you need to do an allocation of a discount? Okay, should the allocation of discount be made? Okay, so the requirement, the situation might be the control of product B and C is basically transferred to the customer at the same point of time, and or product or the company transfer control of product B and C at a different point of time. Okay, so the solution which has been given is product B and C is basically been transferred the control to the customer at the same point of time. Then you does not need to allocate, okay, the discount given to product C. Okay, just recognize it as a whole. That's mean the revenue of 60 ringgit is basically be recognized as a whole when transfer of product B and C is given to the customer at the same point of time. Okay, However, if the transfer of B and C is basically happen at a different point of time, because you need to recognize at a different point of time, then the allocation, okay, then the allocation with regards to the discount we have been given should be calculated separately for product B and C, because you transfer the control at different point of time. Therefore, the recognition of the sale of product B and product C will happen at a different point of a time. Therefore, you need to be able to identify what will be the price of selling product B after the discount given. Okay, so if the transfer of control is basically done at a separate point of a time, then the requirement of allocating the discount become important, because you need to recognize the revenue at a different point of time. So that is basically the idea here. Of course, the first issue is, okay. The first issue is to which product should the discount be allocated. Company have 3 product, but this discount is only given to product B and product C. So the discount should only be allocated to the relevant product, which is product B and product C. However, if the control of product B and C is transferred to the customer at the same point of a time, then the issue of allocating the discount is less important. If the transfer is done at a different point of time, therefore revenue will be recognized at a different point of time, then the allocation will become more important to be shown, because you need to recognize the revenue at a separate point of time from the sale of B and C. Okay, so I think that is that will be my discussion or illustration with regards to the criteria or the step which need to be taken in the recognition of revenue based on MFRS 15. Okay, so we have come to the third step, which is determining the transaction price. We also have reached the fourth step, which is the issue of allocation of the transaction price. But I think with regard to example 7.4, inshallah, I will try to discuss it further, okay, on Wednesday. And I will try to make the illustration more complete, okay, because there is already a few questions which have been raised, and I think that is a very good question which need to be taken into consideration. If that happen, what would be, okay? If that happen, what would be the effect into our recording in terms of the revenue, from the contract with the customer? So, inshallah, first thing on Wednesday, I will try to clarify further example 7.4 before I continue with a further discussion on the remaining issue from the standard MFRS 15. Okay, so I think that will be our discussion today. I will stop here with regard to the discussion. If there is any further issue which you need to bring, and therefore I can think it together, okay, with the question which you have raised before. But I think today I really get a good question from you. I need to think more deeply and more in detail about explaining that issue. Inshallah, I will try to do that on Wednesday. Any other issue which you want to raise to me? Any other things you would like to raise it to me? But let us think together. Don't just leave it to me to think. We can actually think together. So you can also try to provide some feedback or response to the issue which have been raised today. Any other thing? Brothers, sisters, I think today I got question from sisters. Brothers, do you have any question? Yes, sisters, is there any other thing?
No,
Yes,
sir.
sisters, are you saying something? No further question. No further issue. Okay,
No
No,
brothers, do you have
inshallah.
any? Okay. So inshallah, first thing on Wednesday we will discuss again example 7.4. Okay. So I think that is all for today. Thank you very much. Okay. I end my discussion today by Assalamualaikum warahmatullahi taala wabarakatuh.
Waalaikumsalam, sir. Thank you, sir.
Thank
Wassalam.
you.
Thank you,
thank you,
sir.
sir.
Thank you,
Thank you.
sir.
Thank
Thank you, sir.
Thank you.